Hello everyone, welcome to the 12th episode of me learning how to trade using Forex. So in the last video we went through the central banks lesson on the fundamental analysis course on forex.com. We did manage to read through all of this page, but at the end, this end bit here, I think it was done in a rush basically. It was just me reading them through and not really soaking in anything, so I think at the beginning we're just going to reread through this again just so that I can get understanding, like a deeper understanding of what's going on. So the notes we made up to last time, raising interest rates slows things down, which is that bit here. So we're now all on this bit here. So example, say for example that the UK economy is struggling. Banks are concerned about the situation, reluctant to loan out capital. They're scared they might not get it back because the people won't have the money to pay it back, I'm assuming. So for example, UK economy is struggling. Banks are concerned about the situation. Banks are concerned and reluctant to loan out capital. They are scared they might not get it back. As they are scared they might not get it back. So high interest rates. In this environment, high interest rates will encourage banks to hold on to their money. High interest rates. Why? Because they can earn a good return by keeping it with the central bank. So banks, I think by banks, these are the normal commercial banks, I guess, so like HSBC, Lloyds, all that. By keeping it central, where they know it is safe. So they will in turn charge high interest on loans, as they present a relatively high risk. So if they charge high interest on loans, then that's going to discourage people more from them trying to take out the loans. This makes it more difficult and expensive to borrow money. Small businesses may keep their purse strings tight, and prospective home buyers may be priced out of mortgages. Spending remains low overall, and the economy continues to struggle. And that is if the banks apply high interest rates on a struggling economy. So was it the central banks has two options: increase interest rates or decrease interest rates. So increasing interest rates. So if they increase their interest rates, higher interest will encourage banks to hold on to their money. Higher interest rates encourages banks to hold on to their money, as they can earn a good return by keeping it with the central bank instead of lending it out. So they'll charge, instead of lending it out, as they know it will be safe. Therefore, they charge higher interest rates on loans to discourage people from borrowing. This makes it more difficult and expensive to borrow money. It encourages people from borrowing, as it will be more expensive and difficult. Small businesses may keep their purse strings tight. Small businesses may keep their purse strings tight, and prospective homeowners may be priced out of their mortgages. Spending remains low overall. Spending remains low overall, and the economy continues to struggle. Low interest rates, so decreasing interest rates. However, if the Bank of England reduces interest rates, holding onto capital looks a lot less compelling. If interest rates are reduced, holding on to capital looks a lot less compelling. Banks can no longer make much return from keeping money with the BOE. Banks can no longer make much return by keeping it with the central bank. The central banks, but can borrow it at a low cost. But can borrow it at a low cost. But can borrow it at a low cost. Borrow it at a low cost. That means they can offer low interest rates on loans to businesses and individuals. Meaning they can offer low interest rates on loans to people. These loans are now worth the risk because there isn't a safer option readily available. Oh right, okay. These loans are now worth the risk as there isn't a safer option available. Safer option readily available. With more access to cash, and lower rates on savings accounts, people are more encouraged to spend and invest. Higher spending kickstarts the economy into growth. Higher spending then kickstarts economy into growth. Decreasing interest rates. Increasing interest rates. As they know it will be safe, therefore spending remains low overall. How interest rates affects the markets. All this doesn't just affect businesses and home buyers though, it has a significant impact on traders. Let's take a close look at how rates affect Forex and stocks. Forex, foreign currency, looks like any financial asset. Currency prices are set by supply and demand. Like any financial assets. interest rates can also affect Forex and stocks. So Forex, like any financial asset, currency prices are set by supply and demand. Currency prices are set by supply and demand. Investors will flock to economies with comparatively high interest rates because they can get a higher return. But to invest in foreign economies, you need to buy currency. This will increase demand, causing its price to rise. Alright, so investors will flock to economies with higher interest rates as they can get a higher return. Therefore, this increases supply, but to invest in foreign economies, you need to buy currency. Therefore, they will buy the foreign currency, which increases the demand of those foreign currencies, which increases the demand for the currencies, causing its price to rise. Some investors take advantage of this relationship, causing its price to rise. So the reason why it rises is because if there is the same amount of currency, which is the supply, but if the demand rises, then the price is also going to rise. Some investors take advantage of this relationship using a carry trade. In this strategy, you buy a currency with high interest rate while selling one with a low rate. You can earn enough interest to cover any fluctuations in the exchange rate between the currencies, then you can make a profit. Right, okay. Shares indices, so stocks. Some investors take advantage of this by using a carry trade. You buy a currency high interest rate while selling at a low rate. If you earn enough interest to cover any fluctuations in the exchange rate between the currencies, then you can make a profit. Stocks. The relationship between stock market and interest rate is less direct, but they still interact heavily. High interest rates decrease consumer spending. High interest rates decrease consumer spending and makes it more expensive to borrow capital. And makes it more expensive to borrow capital. Both of these outcomes tend to be bad for businesses. Both of these outcomes tend to be bad for businesses, which means that interest rate rises often hurt stocks and indices, meaning high interest rates, meaning interest rates rises often hurt stocks. Low interest rates, on the other hand, low interest rates do the opposite, right? Can boost stock by creating an environment which business can thrive. Low business can boost stock markets by creating environment interest rates can create an environment which allows businesses to thrive. As they can access cheap loans, and also I guess the consumers are willing to spend more, and the consumers are more willing to spend, which enables them to expand their operations. Therefore boosting the stock market. In a low rate environment, savers will also get a poor rate by holding capital for banks, so they may be forced to invest in stocks and stock market instead, further increasing demand for shares. Consumers are also less likely to hold capital with a bank, which increases the likelihood of them investing in stocks. Further increasing demand, therefore increasing demand, which then raises the price of the stock markets. So that means low interest rates is better for stock markets then. No, wait. High interest rates bad for businesses, which means that interest rates often hurt stocks and make it more expensive. Decrease consumer spending, so they're less likely to spend their money investing in stocks, which means the demand for it drops, but the same supply, therefore the stock prices will go down. So at high interest rates, stock prices will go drop. And in low interest rates, stock prices are going to rise. Right, okay. However, traders and investors won't wait just until a rate announcement before taking position. Instead, they scour multiple sources for any clues to what a central bank might do next. Central banks pay a lot of attention to various economic indicators when deciding their next course of action. So traders will also pore over these releases and attempt to second guess what's about to happen. They will also pay attention to the key staff at central bank. Traders pay attention to the key staff at central banks to ascertain whether important decision makers are hawks or doves. To ascertain whether important decision makers are hawks or doves. Hawks are proponents of higher interest rates to fight inflation. Proponents of higher interest rates to fight inflation. Doves to fight inflation. Proponents of higher interest rates to fights inflation. What does proponents mean? A person who advocates a theory, who proposes, hawks up proposers of higher interest rates to fight inflation. So they want to have higher interest rates. What does inflation mean? Inflation measures how much expensive set goods and services become over a certain period, usually a year. How much more expensive something gets over a certain period. Doves want low interest rates to promote economic growth. Want lower interest rates to promote economic growth. You may also hear central banks overall described as hawkish or dovish depending on their policy at a given time. Because markets pay such close attention to central banks, an anticipated interest rate move will usually be priced in long before it actually arrives. Major moves then often arises when a central bank confounds the market's expectations. What does confounds mean? Does that mean confirm? Causes surprise or confusion by not according to their expectations. So doing something opposite that they're going to think. Major moves then are often right. The Federal Reserve announces that it's keeping them low instead. It's expected to raise interest rate, but announces that it's keeping them low instead. It will rise. Low interest rate. What does it mean to the lower? If it lowers interest rates, it will rise. Fed does raise interest rates. What might mean for the gold price? It will rise? No. It will fall. Why does gold fall though? Inflation. Right, okay. Inflation is a crucial factor in economics and plays a key part in fundamental analysis. Inflation is a key factor. Crucial is a key factor in economics. Plays a key part in fundamental analysis. Let's take a closer look at what inflation, hyperinflation and deflation all really mean. As we covered in the previous lesson, central banks must maintain a tricky balancing act. Most have a dual mandate of maintaining high employment while keeping prices stable, and to keep prices stable you need to manage inflation. To keep prices stable, inflation needs to be managed. What is inflation? Inflation is a term for when prices rise over a time in an economy. Inflation, a term for when prices rise over time in an economy. It gets its name because prices are being inflated higher each year, just like blowing up a balloon. While rising prices may seem like a bad thing, they're a part of a growing economy. Most economists today believe that a low and stable inflation rate can help reduce the severity of economic downturns by providing a cushion against falling prices, which can be difficult to manage if they become entrenched. For this reason, central banks will try to keep inflation within acceptable parameters. The Bank of England, for example, has a target of 2%. This means that the prices overall should be increased by 2% each year. If inflation drops below 2%, it may consider lowering interest rates to boost the economy and get it back on track. If it gets too high, then they could raise interest rates to slow down the economy, otherwise they run the risk of hyperinflation. Right, okay, so rise interest rates to lower inflation. lower interest rates to raise inflation. And this is because if you raise the interest rates, then people are less likely to borrow capital from the bank or anything. They're more likely to save up. So they're more likely to save up, then they're less likely to spend their money. If they're less likely to spend their money, then they're less likely to buy stuff, right? Which means which means if they're less likely to buy stuff, then the products won't get sold very quickly. So if it's not going to get sold quickly, then there is no point trying to raise the price of it, because no one's going to buy it. So if it lowers interest rates, then people are more likely to spend their money. So if they're more likely to spend their money, then it's expected that they're more likely to buy more stuff, right? So if they're likely to buy more stuff and they have more money to spend, then whoever the sellers are, like supermarkets for example, can raise the prices of the products they're selling, because the people actually do have the capital to buy the products. So yeah, I think that's how it works. Hyperinflation. Hyperinflation occurs when inflation gets out of control. When inflation gets out of control, prices get too high. Prices get too high, and currency plummets, and the value of currency plummets, and the value of currency plummets. So I guess like currency isn't worth that much. Classic examples include Germany before World War II, Russia after the fall, Soviet Union, and Zimbabwe in the mid-2000s. Usually hyperinflation leads to a total loss of confidence in an economy and its currency. Leads to a total loss of confidence in the economy and its currency. So central banks are constantly on the watch to avoid it. Some analysts argue that the rise in unconventional monetary measures such as quantitative easing in the 2010s could lead to hyperinflation by flooding the market with capital. Deflation. Deflation arises when prices are declining, so inflation is below 0%. When prices are declining, so inflation is below 0%. To the average person on the street, deflation might seem like a good thing. Who wouldn't want the things they would buy every day to get cheaper? Well, manufacturers and producers for one. Deflation means that the margin they make from sales will go down, which hurts their bottom line and may lead to layoffs. As unemployment rises, demand falls. As unemployment rises, demand falls, and companies are hurt even more. As unemployment rises, why does demand falls when unemployment rises? Oh right, if they don't have a job, they don't have the money to buy stuff, so then they're less then they don't want to buy stuff, so demand falls. Right, okay. And companies are hurt even more. And what does this lead to? Even more job losses. This is called a deflation spiral, and it repeats. Demand falls. To avoid this spiral, central banks may consider easing monetary policy when inflation falls. Right, okay. Might seem like a good thing. However, for manufacturers and producers, it's bad. Deflation decreases their profit as means that margin makes which hurts their bottom line, as it hurts their bottom line. Which may lead to layoffs. More layoffs introduce more unemployment. Unemployment decreases demand, as people will have less money to spend. Therefore, companies are hurt even more. So they are less likely to spend it. Leading to more job losses. This is called a deflation spiral. To avoid a spiral, central banks may consider easing monetary policy when inflation falls. To avoid this, central banks may consider easing monetary policy when inflation falls. Reflection and reflation and disinflation. These describe changes in the inflation rate. So reflation and disinflation. Disinflation is when the inflation rate is going up, when the inflation is going up. The other one is when the inflation rate is going down. In the 1990s and 2000s, the Bank of Japan struggled to reverse a stubborn disinflation trend. During this period, inflation remained low and the economy stagnated in a period known as the lost decades. The Bank of Japan struggled to reverse a stubborn disinflation, so when it is going down, when the inflation rate is going down. When the inflation rate is going down, so deflation. So is this more job losses, that or that. During this, inflation remained low and the economy stagnated in a period known as lost decades. 0% interest rates fail to kickstart consumerism or business activity, with the Bank of Japan eventually turning into quantitative easing, in which a central bank buys bonds and assets-backed securities to increase money supply and introduce inflation. In which a central bank buys bonds and assets-backed securities to increase money supply and introduce inflation. How can QE increase inflation? How can QE increase inflation? What does QE stand for? Alright, how is inflation increased? How is inflation increased? Inflation, how is it increased? So inflation is a rise of prices over a period of time. How is it increased? This. A loaf of bread costs 50% more today than it did 20 years ago. This is an example of inflation. A loaf of bread costs 500% more than it did yesterday. Is this an example of hyperinflation? Okay, so company analysis. Fundamental analysis is popular among stock traders who pore over all the available data on a company to decide whether to invest. As with all types of fundamental analysis, examining a company involves researching as much available information as possible to decide whether its shares are underpriced or overpriced. Company analysis falls into two main areas, looking at the company itself and the wider factors surrounding it. Right, so company analysis is as with all types of fundamental analysis, examining a company involves researching as much information as possible to decide whether company analysis falls into two areas. Looking at the company itself and the wider factors surrounding it. Surrounding it to see if it's overpriced or underpriced, to see if its stocks are overpriced or underpriced. Company earnings. The simplest way to take your view on a company is by reviewing the financial figures that it discloses to investors in its earnings reports. Any listed company is required to release earnings, often once a quarter, with more comprehensive statement each year. Simplest way to take your view on a company is by viewing the financial figures it discloses to its investors in its earnings reports. Earnings season. Lots of large public companies will release their earnings during the same rough period each quarter. A time known as earnings season. Earnings seasons can have a significant impact on the overall stock market performance of an economy. If lots of companies miss their expected profits and revenues, major indices may fall. There are a few areas of earnings reports you might want to pay attention to. Right, let me see the time. 39 minutes. Right, let's have a little income statement. So how many income statement, balance sheet, cash flow? Let's write these down first to prepare for the next video. So few areas of the earnings report you may want to pay attention to. Key areas of the earnings report which to pay attention to: income statement, balance sheet, cash flow, earnings report could tell you, but we'll tell you everything. Before you buy, start with some other data sources too. Right, okay. Looking at company itself, wider factors. Earnings tell a lot about business, but they won't tell you everything. Before, you need to look at some other data and where you can investigate, but many is simplify things by taking a top-down approach. Take a top-down approach. Start with the wider economy. Look at specific sectors. Compare the market to its peers. Cool. Right, okay, so we got all the title down. Yeah, okay. I'm gonna leave the video here. So in the next video we're gonna be looking at company earnings, and it's what's it called, earnings report. We're gonna go through the income statement, balance sheet, and cash flow, and then the wider factors which will affect whether the company stock is overpriced or underpriced. So thank you for watching this video. I will see you next time. Peace out.